Hey everybody, I'm Danthika Borst and welcome back to episode 2 of Demystifying Lending, a 4-part series where we make lending easy. If you haven't already seen episode 1, be sure to go back and watch that so you get all caught up. Today we're going to be talking about I'm under contract, now what? Let's go. Sheryl, so I've got my buyer under contract and I send you the contract. What do you do first and what's the next step?
Well, the next step is I'm going to look over the contract, make sure all the signatures are on there, and then I'm going to plug in the numbers that are on the contract, such as purchase price, the seller paid closing costs if there are any, closing dates, things like that. And then I'm going to disclose the loan, which that means that I'm sending you, the borrower, the documents that you'll need to e-sign within 3 days. If you don't e-sign them, then I have to mail them, and that's going to take a lot longer and slow down the process.
So what does it mean to disclose the loan?
Sure. So that means it's basically a lot of documents. It's going to be your loan application that you have to sign and all the legal disclosures, as well as something called a loan estimate. And a loan estimate basically is just that. It's just an estimate. It gets the loan going, gets the process going. There's a lot of numbers on there that will change.
So something that we hear a lot about is the word closing costs. And then into that mix we also hear the word prepaids. What are those two things and what is the difference between them?
Sure. Your prepaids are things like interest. So if you close at the very last of the month, you'll pay 1 day of interest. If you close the middle of the month, then you'll pay about 15 days of interest. So it's just based on what day you close. You also need to pay 1 year of homeowners insurance up front. And then you'll also have something called escrows. You are going to have escrows. What escrows are, if you think of escrows like a little savings account, each month that you make your mortgage payment, you're also making a payment to your escrow account. Your escrow is going to be your property taxes for 1 month and also your homeowner's insurance for 1 month. And all that at the following year when the homeowner's insurance is due, then that will be paid out of your escrow account. And then when the tax bill is due, that amount of money will come out of your escrow account as well. So the one thing I do caution my borrowers about is that they'll ask me, does my payment ever fluctuate when I have a fixed rate? And the answer is yes, because next year your property taxes might go up, especially with our home values here in Atlanta increasing, then the property taxes might go up. And then same thing with your homeowner's insurance. Your homeowner's insurance may go up, you may shop around for it the next year, and it may go down. So yes, your monthly payment can change slightly.
Okay, so you would say that the prepaids are basically the costs involved in the ownership of your house.
That is correct.
And what are closing costs?
So your closing costs are things like the attorney's fee, the government fees, there's recording fees that the state and the county charges. There's just a couple of other things. You do have an appraisal. The appraisal is the only thing that should be paid for up front, and because the appraiser has to get paid no matter whether you buy the house or not.
Part 2 is done, guys. What did you think? I hope you were able to learn a little something from this series. We're not quite done yet. We're halfway through, so be sure to tune in next time when we talk to part 3 of our series. I'm Danthika Borst and I'll see you guys later. Please make sure to like, share, subscribe and comment if you have any questions. Thank you so much for watching and I'll see you later.